Okay, and we're back, and we're going to talk about some of the fancier stuff in international tax. We're not going to cover all of the slides, there are about 20 of them, that I distributed. We're just going to talk about selected pieces. We should be able to finish up by 7:45 on this segment of it. I haven't heard back from you on preferences, so I'm going to focus heavily on check the box. But first, let's talk about mixer companies. Mixer companies is a term that's been around for the entirety of my career. The concept is you have a subsidiary that holds various joint venture companies or various checked entities in different countries that have differing tax rates. And the idea is to get your tax rate in the mixer company to something that when it pays dividends, you can use the credits, and possibly if the companies have high enough tax rates, you could perhaps avoid some of subpart F. So the term mixer company is simply a company that is used to blend tax rates. There's no particular magic from a tax side to setting it up or doing anything with it. This is just a definition of a term that you may hear bandied around. And the tax rate of the mixer company then is the blend of the tax rates of the various subsidiaries. So let's talk about check the box. We're all familiar with U.S. LLCs. A single member LLC is disregarded as separate from its owner. And a multiple member LLC is treated as a partnership, unless we elect something else. Well, this is under the check the box rules. First, a little bit of history though. Back in the 80s and 90s, before the check the box rules came about, I was regularly doing the same thing without them. It took a little more work. We charged a higher fee. I thought that was a good thing. The clients didn't, but I did. And we accomplished the same result with one little item of uncertainty. I had always argued, and I was in the minority on this, that a single member entity that was a flow-through was treated as a branch. So when the check the box rules came along, they did one thing they did one thing for me and one thing to me. The thing they did for me was resolve that potential uncertainty on how to treat a single member flow-through entity. The thing they did to me is cut my fees a little bit. But the IRS, thankfully, caused all this publicity about it, and everybody wanted to get in on the act, so my fees didn't really go down. So that was a good thing. So what does it take to be able to check the box? First, we have to have an entity eligible to do so. Well, the check the box regulations have this big long list of entities, one per country, that are not eligible to check the box. They are treated per se as corporations. Okay, that's all well and good. Sorry, that's all well and good. Then there are some other requirements to be able to check the box. In addition, there are some defaults. You get to make an initial election for any entity that is eligible to make an election. And if you don't make an initial election, it defaults to something. And the default for non-US entities is based on whether there is any member who has unlimited liability. You may have heard of Nova Scotia and now Alberta and at least one other Canadian province, unlimited liability companies. And those entities are eligible to check the box. By contrast, a regular Canadian corporation is treated per se as a corporation and can't check the box. So you need to look at those rules to figure out whether you can do anything. Now, once you've made that initial election, or it defaulted to something, you can change your mind. And you can change your mind anytime you want, once. After you've changed it once, you're locked in for 60 months, not 5 years, not 5 tax years, 60 months. You can change your mind any day of the year, whether it's the last day of the year or not. You can change your mind today and make it effective at a different day besides today, simply by filing Form 8833 and specifying what date. That date can be retroactive by up to 75 days. So if I've got a CFC that's eligible to check the box, and it's treated as a corporation right now, I can say, on October 18th, I want it to change from being a corporation to being disregarded. Okay, so that works, as long as I file that Form 8833 within 75 days of that date I want it to change. Sorry about the alignment here. So if I've got a CFC and it's not treated as a corporation at a particular moment in time, then what is it? Well, if it has one member, it's a branch of that member. If it has more than one member, it's a partnership. Pretty simple. Just like LLCs. What happens if I change that, though? Well, if I have an existing entity and change it from corporate status to non-corporate status, then I have a deemed liquidation. Now, that may be good. That may be fine. It may not do much of anything. If it has one owner, and that one owner is treated as a corporation, and I check the box so that it's deemed liquidated, it's a 332 liquidation. And if that one owner is foreign, all I've done is move the earnings and profits and create a QBU out of a subsidiary. There's some neat opportunities that present themselves here. And there's another neat opportunity too. If I want to check the box up to 75 days ago, I can do so. I don't have to do it the minute I want it to be effective. But there's also the potential for making a retroactive election. The IRS has procedures now that allow a change of an election or an initial election under certain circumstances. Those procedures are explained on Form 8833. Now, I would ask that each of you pull up Form 8833, and let's just go ahead and do that now so you can have a look at one of those. It's not a real tough form. Not a real tough form. I'm sorry, it's 8832, duh. I'll get it right. Not a tough form. The 8833 is not a tough form either. But 8832 is just check the box. Pick what you want, disclose a few things, and that's it. See, you get to pick what it's going to be down here by simply checking a box. And then everybody that owns it has to sign it. Simple form. Now, I mentioned there's potential for doing other things. That's on the third page. It's called late election relief, and the form has the instructions built into the form. And you have to explain why you didn't file the election that you want on time. This is where we accountants can fall on the sword and make things better. Or there may be some real good reasons. Now, the IRS is looking for two things here to approve your late election. The first is a plausible explanation. It doesn't have to be the best one in the world, it just has to be plausible. And the second is they're looking for consistency of treatment. If you have always treated something some way and are making this late election, and there's some plausible reason, the IRS will grant the election. They'll get out the rubber stamp and say yes. If you're changing how something is treated from how you reported it before on a tax return, then they'd better be a really good reason, because otherwise they won't rubber stamp it yes. So again, Form 8832, piece of cake, and you get to play all sorts of fun games with it. One of the things that we have the potential of doing in tax is splitting earnings and profits from tax. And we used to do this before check the box elections, but check the box now makes it easier. If I have one entity that owns some part of another entity, and that other entity is normally treated as a flow-through, then the first entity would get the earnings and get the tax at the same time. If, on the other hand, we use a check-the-box election to change the character of that flow-through entity to non-flow-through for U.S. purposes, then we may be able to cause, under foreign law, our owner entity to be the one on whom the tax is imposed, while our flow through under local law, not flow through under U.S. law entity, is the one that has the earnings. Now, this was a really good trick for several things, not just for a foreign entity, but this had been used by some planners for a U.S. owner splitting earnings from the taxes. So the U.S. owner would have the tax and wouldn't have the income. Well, you know they had to do something about that. So Congress enacted Section 909 that partly got rid of splitter structures. For this situation, where it's a U.S. owner with a foreign entity, new Section 909 says the earnings and tax get stuck together. You only get to recognize the tax when you recognize the income. However, splitter still works if there's a foreign entity up on top and that foreign entity is not getting subpart F income as a result of this. In other words, if there's no current U.S. taxation of this lower tier earnings, then the taxes can flow up to the upper tier entity. So 909 is quite limited as to what it does. It gets rid of that very abusive planning structure where the taxes were brought back in to be foreign tax credits, but the income was left offshore. But it still retains that splitting of income and tax on a foreign to foreign basis. So on that note, let's move to, I'm going to skip ahead in our notes if you don't mind. No, I'm not. It's in the right place. Let's talk about some various corporate events that can happen. The first and simplest is I own a CFC, I sell the shares. Section 1248 says, okay, if you sold the shares, you have to recharacterize the gain to be a dividend to the extent of any non-previously taxed earnings and profits. 1248 used to be, way back, really, really important for corporations and for individuals. In the current environment, where dividends and capital gains are treated the same, or taxed at the same rate, rather, doesn't matter much for individuals. So we move it from one line on the return to another. But it does matter a lot for corporations because, if I've got a CFC, I would much rather have a dividend than I would capital gains if I'm a corporation. Because the dividend brings the tax, the deemed paid tax, with it. So let's talk about the threshold for 1248 and what it does and when it doesn't apply. Because I want to get, if I'm a U.S. corporation, I really want to get into 1248 if I sell my foreign sub. I want to make sure 1248 applies. So when does it apply? On any sale or exchange or any distribution treated under the corporate sub-C rules as an exchange. But here's the rub. Only applies for a U.S. person selling shares of the CFC. It only applies if the seller held more than 10% at some point in the past 5 years. In other words, if I was a U.S. shareholder of a CFC at any time in the last 5 years and sell those shares, then 1248 applies. And it only applies if there's gain. 1248 does not cause income. It merely recharacterizes gain. So if there's no gain that's otherwise recognized, then 1248 doesn't do anything. If a non-recognition provision applies, 1248 doesn't do anything. Now, I'd use caution here. We're going to talk about a really nasty section in a little while. Section 367. Now, 367 doesn't directly impact 1248. However, 367 may get rid of your non-recognition provision. Now, that's not necessarily a bad thing if I'm going to bring in a bunch of foreign tax credits. So we got to think about that. Now, 1248 doesn't apply to everything. It doesn't recharacterize income that's excluded under the subpart F provisions. It doesn't do anything for prior PFIC inclusions that are considered brought out tax-free. So there's some limits on 1248. Now, the concept of prior subpart F inclusions is a 1962 concept before they changed section 959, tweaking it around a little bit. So it's a much simpler concept, and that may be good or it may be bad. There's some other exclusions that we're not going to talk about here, or I'm sorry, exceptions. So 1248 as a corporate shareholder is something that we want to get into. Now notice that there are two exceptions to 1248 here that are kind of critical. If something is treated as a dividend, well, then all 1248 does is say this gain is a dividend. Then if it's treated as a dividend, there really isn't any effect. So that's excluded. If it's something treated as ordinary income anyway, then 1248 doesn't kick in. There's a complex anti-avoidance rule in 1248 that says the taxpayer has to demonstrate that what the earnings and profits of the foreign subsidiary is. Otherwise, everything is treated as distribution of E&P and a dividend. Well, if I'm a corporation and I want to yank out as much of the foreign tax credits as possible, can I use this proactively and tell the IRS, I'm just not going to show you? Meh. Well, apparently so. So if I fail to demonstrate the E&P, then it's all treated as the whole distribution is treated as E&P and recharacterized as a dividend. But is it all general basket or not? That's a good question. Nice theoretical, philosophical question for a later life. Let's go on a little bit more. This is part of subpart F that we already covered. Now I'd like to talk a little bit about the nasty of nasties in the international area. In your corporate tax class, you talked about reorganizations. You talked about various sub-C events like contributions to capital, liquidation of a subsidiary, or of an 80% subsidiary. All these nice things that kept you from recognizing gain on transfers involving a corporation. All that's well and good, and it works just fine in the international arena. But there's something that turns that corporate switch off. It's section 367. 367 basic rule is says for certain kinds of corporate events, if the regulations don't provide otherwise, the entity that you're seeking to treat as a corporation is not a corporation, and sub-C doesn't apply. For other kinds of transactions, it says if the regulations don't say otherwise, then sub-C does apply. So with 367, you have to look at what direction the transaction is. Is it inbound, outbound, or foreign to foreign? And once you've determined that, then you have to look at the regulations for that particular direction of transaction. There are separate regulations for those. And say, okay, what does this do to me in this corporate event? 367 can kill your reorganization. It can make it a taxable event. There are exceptions, though, to killing it. There are exceptions to saying that outbound transfer of assets is taxable. So you have to get involved with 367 anytime there's an international corporate event. And I got news for you. This is the hardest code section of them all. We're not going to talk much about it in the course because it is that hard. What I want you to be able to do is recognize every time you see an international corporate event that you must look at 367 to see whether the sub-C rules, sections 301 to 369, apply at all. Now I'd like to just extemporize a little bit about another topic that may be of considerable interest to any of you. And if it's not, you can tune out, turn off, and call it quits until we get together at 8 o'clock for the video call. We'll talk about PFICs. Passive foreign investment companies. Now, in the corporate arena, PFIC doesn't really have very much relevance because of the other things that apply to U.S. corporate shareholders. For individuals, the PFIC rules are quite significant. PFIC was passed in 1986 with a very basic fundamental goal. And unfortunately, they drafted it too broadly. The idea was to treat a foreign mutual fund the same for a U.S. individual owning it as a U.S. mutual fund. Unfortunately, they drafted it a little too broadly, and it treated any foreign corporation that met the PFIC tests, the asset or income test to be a PFIC, as this nasty thing, and even if it was already a controlled foreign corporation. Fortunately, Congress saw the error of their ways in 1997, it took them 11 years, and put an exception in that says a CFC is not a PFIC with respect to the U.S. shareholders. But only after 1997. So what's a PFIC? It's a foreign corporation that has more than 75% of its income or more than 50% of its asset. More than 75% of its income is passive income, or more than 50% of its assets generate passive income. And what happens if you have a PFIC? Well, if you get an excess distribution from a PFIC, then you are treated as if that distribution was additional income over your entire period of ownership on a daily pro rata basis. You have to pay tax on that additional income at the highest marginal tax rate for whatever type of taxpayer you are, or rather were, in that particular year to which the income is apportioned. An excess distribution is any gain on the shares or any distribution in excess of 125% of the average of the prior 3 years' distributions. Now, this tax and interest regime can be downright confiscatory. If you've had a PFIC since 1986 and it's appreciated the same as inflation over those nearly 30 years, you probably should simply endorse the shares over to the IRS in payment of tax. One of my former professors recommended doing so in red crayon. I think magic marker would work too. And say to be applied against any and all of my tax liability and transfer title to them. He wasn't referring to PFICs, he was referring to valuation questions otherwise. But PFIC has the same potentially disastrous effect. There's tax and interest, and the tax is at the top marginal rate. There are ways to avoid this PFIC tax and interest regime. The principal way to do so is to elect to treat the PFIC as a qualified electing fund, or QEF. That is, you submit to what Congress was trying to do. You treat it as if it were a regulated investment company and recognize your share of ordinary income and capital gains each year as the PFIC earns it. Now, this is all well and good if it really is a foreign mutual fund and is tracking that stuff and would let you, as a U.S. investor, invest in it. For many years, up until fairly recently, it was not at all uncommon to have U.S. investors in foreign mutual funds, and they'd get this annual PFIC statement that looked an awful lot like the detail you get with your U.S. mutual fund shares. Lately, the foreign mutual funds have been kicking out the U.S. investors. But if it's treated as a QEF and the foreign mutual fund allows the IRS to look at their books and gives you an annual statement, then you simply include your share of income and capital gains each year. You go your merry way, and there's no such thing as an excess distribution. This is what Congress wanted you to do. There are a couple of other options, and they're not really that great. But they get you out of the tax and interest regime, so they're a little better. If you're a U.S. shareholder of a PFIC, starting with respect to 2013, I believe it was, you must file, and for prior years, if you had excess distributions, you must file, and you've always been allowed to file Form 8621. Now, Form 8621 is a little more complex than the check the box form, but it's not too bad. The first question, though, is, are you making any of these elections? And then it has some boxes to check. And I used to jokingly tell my staff, you check that box, I break your fingers. Now, remember, I was in the New York metro area, so they could get it even though The Sopranos hadn't started airing yet. Those elections have potentially dire consequences, or they could be really good. You have to think about those boxes to check on the Form 8621. After that, it's pretty ordinary and well organized. You have to report your share of ordinary income and capital gains if you're a QEF. You have to report the gain as if it were sold under the mark-to-market election, et cetera, et cetera. So it's pretty ordinary stuff. Now, Form 8621 is required now. Now, what's the threshold for ownership of a PFIC? Tiny. If I own one share out of 48 million shares in this investment company that's foreign, then it's a PFIC with respect to me. Or I should say, that share is a PFIC share with respect to me. Any amount of shares, no matter how small a percentage. This isn't like Subpart F, where there's a 10% ownership threshold. Any percentage of shares. And once a particular share is a PFIC share, it's always a PFIC share, and it's tainted with this tax and interest regime until I get rid of it, or until I make a purging election. And those purging elections are some of those boxes that I mentioned that you shouldn't check without considering it very carefully. So this is kind of a brief overview of PFICs. If you want more details, I've published a link to my article with Bob Feinschreiber from, are we ready for this? 1992 on PFICs. And most of the rules are exactly the same. There's been a little bit of change in the PFIC rules with respect to partnerships that own PFICs and who makes the election for QEF, mark-to-market, etc. But otherwise, that article is still good. It's not short. So if you want more information on PFICs, I encourage you to read the article. And with that, we come to the end of this course. So I'm open for questions, and I'm going to stop